Do you have a passion for banking? Do you want to work in the banking sector as your career? Well, a lot of people want to follow in their footsteps, but very few actually manage to do so. Having the necessary commitment, enthusiasm, and, above all, knowledge and comprehension of the banking industry will undoubtedly aid in your success as a banker. A thorough understanding of various terms and concepts is necessary to become a responsible banker. One of those many ideas is known as repo rates, though. Now let's explore what repo rates are and what they mean. Let's start with the repo rate. The repo rate, short for repurchase rate, is the rate at which the Reserve Bank of India, RBI, lends money to commercial banks in the country. This is typically done through repurchase agreements. Essentially, commercial banks borrow money from the RBI by selling government securities with an agreement to repurchase them at a later date at a higher price. Think of it like a pawn shop transaction. A bank pawns its securities to the RBI in exchange for cash, promising to buy them back later. The interest rate applied to this transaction is the repo rate. But why does the repo rate matter? It's a tool used by the RBI to control liquidity in the Indian economy. When the RBI wants to increase the money supply, it lowers the repo rate, making it cheaper for banks to borrow money. This, in turn, encourages banks to lend more to businesses and consumers, stimulating economic activity. Conversely, if the RBI wants to reduce the money supply to curb inflation, it raises the repo rate, making borrowing more expensive. This helps to slow down spending and investment, cooling off an overheating economy. Now, let's talk about the reverse repo rate. This is the opposite of the repo rate. It's the rate at which the RBI borrows money from commercial banks. In this transaction, banks lend money to the RBI by purchasing government securities from them, which the RBI promises to buy back at a later date. In simple terms, the reverse repo rate is the interest rate the RBI pays to commercial banks for parking their excess funds with the central bank. But why would banks do this? Well, during times when there is excess liquidity in the market, banks prefer to park their surplus funds with the RBI as it is a safe investment. By adjusting the reverse repo rate, the RBI can influence the amount of money banks are willing to lend out. If the RBI raises the reverse repo rate, it makes it more attractive for banks to park their funds with the RBI, reducing the amount of money circulating in the economy. Lowering the reverse repo rate, on the other hand, encourages banks to lend more to businesses and consumers, increasing the money supply in the economy. In summary, the repo rate and reverse repo rate are powerful tools used by the Reserve Bank of India to manage liquidity and control inflation in the economy. By understanding these rates, you can get a better grasp of how monetary policy impacts your daily life, from loan interest rates to the overall economic environment. To recap, repo rate, the rate at which RBI lends to commercial banks. Lowering it increases liquidity, raising it decreases liquidity. Reverse repo rate, the rate at which RBI borrows from commercial banks. Raising it decreases liquidity, lowering it increases liquidity. Thanks for watching. If you found this video helpful, make sure to give it a thumbs up and subscribe to Finance Simplified for more insights into the world of finance. Have any questions? Drop them in the comments below, and we'll be sure to answer them. Until next time, stay financially savvy.